What is roll yield in commodity index investing? Imagine you are watching the price of a commodity like oil or gold change every day. But when you invest in a commodity index, you are not just betting on spot prices. You are also dealing with something called roll yield. This is a hidden factor that can make or break your investment returns over time. Let's uncover what roll yield really means and how it impacts your investment. When you invest in a commodity index, most of the time it uses futures contracts. These are agreements to buy or sell a commodity at a certain price on a future date. These contracts expire every month or every few months. To keep your investment exposure, the index has to sell the contract that is about to expire and buy a new one with a later expiration date. This process is called rolling. The key point is that the price difference between the expiring contract and the new one affects your returns. If the new contract is more expensive than the one you sell, you lose money when you roll. This situation is called Contango. For example, if the front month crude oil futures are at $70 and the next month's futures are at $71, rolling costs you $1 per contract. Over many rolls, these costs add up and can reduce your total returns. On the other hand, if the new futures contract is cheaper than the expiring one, you make a profit when you roll. This is called backwardation. For example, if the next futures contract is at $69 while the expiring one was at $70, rolling gives you a $1 gain per contract. This positive roll yield can boost your overall returns. The shape of the futures curve determines whether the roll yield is positive or negative. When futures prices are higher for longer dates, it's called Contango. When futures prices are lower for longer dates, it's backwardation. The slope of this curve influences how much profit or loss you get from rolling futures contracts. Over time, the effect of roll yield can be just as important as changes in the spot price of the commodity. If markets stay in Contango for a long period, your returns can be dragged down significantly. Some newer commodity indices try to improve this by using smarter rolling strategies. They might pick contracts that have better roll yields or use multiple contracts along the curve to reduce costs. For investors, understanding how and when roll yield works is essential. It can help you choose the right index product or decide when to buy or sell. Some indices focus on commodities in backwardation to maximize positive roll yields. Others try to avoid the negative effects of Contango by adjusting their rolling methods. In simple terms, roll yield is the profit or loss you get from moving your futures contracts forward. It depends on the shape of the futures curve and can greatly influence your overall investment results. Knowing about roll yield helps you see beyond just spot prices and understand what really drives your returns in commodity index investing.